Hello, everyone, and welcome.
I'm Amy.
And I'm Tom.
Imagine for a moment a crucial global artery, right? A single strategic waterway. And through it flows, what, a fifth of the world's crude oil supply? A staggering amount. Now, what if that choke point suddenly faced the threat of closure? How would that ripple, not just through financial markets, but, through our everyday lives? It's a pretty unsettling thought. And today we're diving deep into exactly that scenario. We're going to unpack the dramatic recent escalation in the US-Iran conflict and its tangible impact on financial markets worldwide. Our mission for this deep dive really is to help you quickly grasp the why and the what's next behind these complex interactions. Between geopolitical events and market reactions, we've pulled insights directly from the very latest daily market reports and analysis. It's basically your shortcut to being truly well informed.
Absolutely. And we have some incredibly timely sources guiding us today. It's a mix of fresh market insights, economic data, geopolitical analysis, all hot off the press from June 23rd, 2025. Our focus, like always, is to really pull out the most important nuggets of knowledge from all this timely info, help you connect the dots.
Okay, let's unpack how this all kicked off. The fuse was lit over the weekend, right?
Yeah.
And it sent an immediate shockwave across global markets. So Saturday, June 21st, 2025, the U.S. military launched strikes on Iranian nuclear facilities. And we're talking specific high-value targets here: Fordo, Natanz, and the Isfahan nuclear sites. President Trump himself came out and stated the U.S. had, quote, obliterated Iran's primary nuclear sites. That's a powerful declaration. It certainly got the world's attention.
It really did. And the immediate fallout was, well, a stark warning from Iran's foreign minister, Abbas Araghchi. He spoke pretty ominously of consequences. What's particularly striking is how quickly the global concern pivoted right to the strategic Strait of Hormuz. Reports even emerged from Iran's press TV that their parliament had approved a measure to actually close the strait. Now, it's really crucial to note this. Such a huge move still requires the ultimate approval from Supreme Leader Ayatollah Ali Khamenei. That's the key approval needed, and it's what has everyone basically holding their breath right now.
And you can absolutely see why. If the Strait of Hormuz were to close, the implications would be immense. They'd cascade right across the entire global economy. This choke point, it's nestled there between the Persian Gulf and the Gulf of Oman. It's where roughly, like we said, a fifth of the world's crude oil supply transits. Just try to picture that immediate, tangible impact on your daily life. Soaring energy prices, right, at the pump, on your utility bills, and the cost of pretty much everything that relies on transport. It's a massive disruption just waiting to happen, not just theoretical.
Yeah, and this raises an important point. I mean, Iran has certainly made similar threats in the past, right?
Right.
Without actually acting on them. So what makes this time potentially different? What lends greater weight to the possibility now, creating such heightened market anxiety compared to, previous tensions?
Right.
It's the current level of conflict. This isn't just rhetoric anymore. We've actually seen direct military action. And while, yes, there are some alternative pipeline routes that could bypass the strait, they simply cannot fully compensate, not for the sheer volume of crude oil that would be trapped if that vital waterway became inaccessible. That's the cold, hard truth of it, and it's why markets are taking this threat so seriously this time.
Okay, so with that geopolitical backdrop pretty clearly laid out, how did these tremors actually hit the global financial system? Let's trace the incredibly volatile journey of oil prices first. That's where the immediate impact was, well, most visible. Just last Friday, we actually saw a slight decline in oil prices. That was influenced by new Iran-related sanctions, which, initially fostered some optimism for maybe a negotiated resolution. But then the weekend strikes happened, and market sentiment just shifted dramatically at the start of the new trading week. Oil prices surged, highest level since January. Brent crude, that's the international benchmark, it jumped to $81.40 a barrel. And WTI, the U.S. benchmark, hit $78.40. If you look at the bigger picture, just since June 12th, Brent is up over 11%. WTI over 10.6%. That's a huge, rapid move.
It is. And it's particularly intriguing how gold behaved amidst all this. Gold is traditionally seen as that reliable hedge against political economic uncertainties.
The safe haven.
Exactly. But on Friday, gold saw minimal change. It actually contributed to a weekly decline of nearly 2%. Now, this short-term dip, despite the immediate conflict escalating, is, well, it's somewhat counterintuitive for a safe haven asset, isn't it?
Yeah, it's strange.
It suggests that while, yes, immediate geopolitical fear definitely drove oil prices, investors might also be weighing other factors, things like, the Federal Reserve stance on inflation or broader economic fundamentals, perhaps. So this creates a more complex, maybe less predictable flight to safety than you might expect. However, if we connect this to the bigger picture, gold prices are still up almost 28% year to date,
Wow.
which indicates that overall the market has been pricing in sustained geopolitical tensions and economic uncertainty for quite some time now.
Okay, moving over to the broader U.S. stock market. We saw, well, a mixed picture last week. The tech-heavy NASDAQ composite, for instance, it faced some headwinds on Friday, but interestingly, for the whole week, it still managed a small gain, 0.21%, which suggests that maybe the underlying tech story remains pretty resilient despite these geopolitical jitters. The broader S&P 500 and the Dow Jones Industrial Average saw more muted movements. Seems to indicate a kind of broad wait-and-see approach from investors, maybe not full-blown panic. Beyond just the big indices, what individual companies really stood out, for better or worse, in response to this volatility and these broader economic themes? Well, take Kroger, the grocery retailer. They delivered mixed quarterly results, but they actually upgraded their forecast, and they even noted that tariffs haven't materially impacted them yet. That's pretty significant in this environment. Then you have CarMax shares. They jumped over 6% after reporting better than expected Q2 results. What's fascinating there is the company even suggested that uncertainty around tariffs on new cars might have actually stimulated demand for secondhand vehicles.
Interesting. An unexpected side effect.
Exactly, an unexpected tailwind from trade tensions.
Right. And conversely, you saw companies directly impacted by these themes, feeling the pinch. Smith & Wesson brands shares, for example, plummeted nearly 20%.
Ouch.
Yeah. Lower profit and sales, and that was compounded by a warning about increased production costs because of steel tariffs. And if you look at the sectoral performance within the S&P 500, it tells a very clear story about where capital flowed. Energy was the best performing sector, gaining over 1%. You had companies like Williams Companies, EQT, Kinder Morgan leading the charge there.
Makes perfect sense with the oil surge.
Exactly. And conversely, communication services was the worst performing sector, down almost 2%, led lower by names like Alphabet and Meta Platforms.
Yeah.
So it really highlights where investors sought safety
Yeah.
and where they pulled back capital amidst these escalating tensions, favoring traditional energy over, say, growth stocks.
And drilling down even further, those mega cap movements. We saw Apple up over 2%, but Alphabet, as you mentioned, down almost 4%. Nvidia slipped to over 1%. And across the Atlantic, European stock indices showed some divergence too. The CAC 40 in France and the DAX in Germany both saw gains, while the FTSE 100 in London experienced a slight decline. It's like a global economic kaleidoscope, isn't it? Different pieces shifting in response to the same underlying forces.
Currencies offered another fascinating read on market sentiment. They acted almost like a barometer. The U.S. dollar initially advanced against safe haven currencies like the Japanese yen and the Swiss franc on Friday. That was partly due to an initial, though very brief, perception that maybe Middle East tensions were subsiding a bit.
Right, after Iran signaled support for talks.
Exactly. But that sentiment shifted very quickly, led to a marginal decline for the dollar index on Friday, though it still clocked a weekly gain of over 0.5%. The euro and British pound sterling also saw varied performances. What was particularly notable, though, was the Swiss National Bank's decision. They lowered their key interest rate to 0%.
0%. Wow.
Yeah. A move that definitely contributed to the franc's decline and really underscored how global central banks are taking different approaches to economic stability right now.
And in fixed income, let's talk U.S. Treasuries. We saw yields fall on Friday. Why? Well, because the escalating Iran concerns significantly boosted the appeal of safe haven government bonds. Simple as that.
Flight to safety.
Exactly. It's interesting, though, to note the differing views bubbling up within the Federal Reserve, the FOMC. You had Governor Christopher Waller suggesting a near-term rate cut could be justified by recent moderate inflation. He hypothesized that any price shocks from import tariffs might be short-lived. But then you had San Francisco Fed President Mary Daly saying she sees the Fed's policy as, quote, in a good place, and anticipates cuts maybe only in the autumn.
So not quite aligned there.
Not exactly. Last Wednesday, the FOMC did hold rates steady, but they signaled future decreases. Though Chair Jerome Powell cautioned against over-reliance on that outlook, he expects meaningful inflation from planned import tariffs. So the 10-year U.S. Treasury note yield, as a result of all this, declined 1.3 basis points on Friday, ended the week down 2.3 basis points overall.
And across the Atlantic, it was a similar story. Eurozone government bond yields were broadly lower for the week. Investors shifted capital into safer assets amid the conflict, just like in the U.S. What's particularly indicative of increased risk aversion in Europe, though, is the widening of yield spreads between the government bonds of more indebted nations like Italy and France and their German counterparts.
Right, the risk premium increasing.
Precisely. The spread between Italian 10-year yields and German bunds, for instance, widened by 2.3 basis points over the week. That reflects that heightened concern among investors about sovereign risk in, let's say, more vulnerable economies.
Okay, now let's pull back a bit and look beyond the immediate conflict. Let's consider the broader global strategic implications here.
What's truly critical, I think, are the wider concerns. Beyond just these immediate strikes, we're talking about the increased likelihood of a wider regional war that would destabilize the entire Middle East, and even the unsettling possibility of Iran-sponsored or perhaps associated terror attacks globally. This raises a tough question. How do nations respond when the threat expands far beyond a defined conflict zone, when it moves into a more diffuse, unpredictable landscape?
Interestingly, initial reactions from Iran's allies seem to suggest a degree of restraint, at least publicly. Hezbollah, a major regional player, has indicated it will not join the conflict directly, and other regional proxies are believed to have been weakened somewhat by previous actions. However, despite this initial public posture, the situation is clearly causing significant unease for both China and Russia, two major global powers whose interests are deeply intertwined in the region.
Absolutely. For Beijing, the primary concern is its heavy reliance on discounted Iranian oil. That's a critical energy source, particularly given existing sanctions. So heightened regional instability directly impacts China's energy supply lines. What's also crucial, I think, is that China views direct U.S. military action like this as a potential precedent.
Ah, right.
It significantly increases its sensitivity to any perceived U.S. threats concerning Taiwan. They're watching closely to see how far the U.S. is willing to go with military interventions. It's all interconnected, in a complex geopolitical dance.
And for Moscow. The escalation raises worries that its supply of military equipment from Iran could be disrupted. This is a critical concern for Russia. It could potentially weaken its operational capabilities in the ongoing war in Ukraine, where Iranian drones and other arms have played a pretty notable role.
And the U.S. stance, as articulated by President Trump and his senior officials, is that these airstrikes are limited and targeted. They're framing it as a tactic, really, to compel Iran toward a peaceful resolution, prevent further nuclear proliferation. But simultaneously, they've been very clear threatening further military action should Iran retaliate or refuse to negotiate. It's a very delicate diplomatic dance, trying to project strength while maybe leaving a perceived door open for de-escalation. Extremely high stakes.
So we've covered a lot: the intensity of the situation, the immediate military actions, and those swift, significant market responses across oil, gold, stocks, currencies, bonds. This deep dive really demonstrates just how quickly geopolitical events can translate into financial ripples. It underscores the profound interconnectedness of our global systems, doesn't it? It's like pulling one string in a massive, intricate tapestry and watching other threads vibrate far, far away.
It really is. This deep dive has certainly illuminated the immediate reactions to a significant geopolitical escalation. But maybe consider this as you go about your week. If the perceived safety of a haven asset like gold can fluctuate so much, even on a weekly basis, and if the world's oil supply hinges so precariously on a single strait, what does that tell us about the true nature of stability in what feels like an increasingly volatile world? What might be the next unexpected trigger for global markets? And maybe more importantly, how can we even begin to prepare for the unseen consequences that ripple out far beyond the initial shock? It's certainly a lot to ponder.